Hello viewers, I'm Stuti Agarwal. Welcome to Invesfinc Advisors channel. So today we are going to discuss on a very important topic, which is that why do retailers lose money in the stock market? So did you know that 95% of the retailers lose money? If you have been trading in the stock market as well, then you might relate with these 3 points that I'm going to present. First one being herd mentality. So most of us initially start with the buy recommendations given by our friends, family, or someone from social media. Without proper knowledge, most of the retailers jump to buy the stocks even without knowing that what does the company do. Secondly, lack of patience. This is pretty common. Retailers make this mistake pretty often after knowing that everything takes its own sweet time to show results. Third one being wrong entry and exit points. This is somewhat related to the first 2 points that I talked about, because when a retailer does not know how does the stock market actually work like, or does not do their own research, they might just end up buying the stock near its top, and when the smart money actually exits the stock, the retailer panic sells and sells the stock and basically loses the money. So this chart actually talks about the different phases that a stock goes through. So there is not any set time limit to how long the market cycle could be, but usually it is taken as that a cycle could be of 4 to 5 years. So firstly, there is a stealth phase in which the smart money starts to accumulate the stock. Secondly, there is an awareness phase in which the institutional investor starts to accumulate. This might also include the bear traps. Thirdly, there is a mania phase. Mania phase includes media attention, enthusiasm, greed, delusion, and uh, public attention, as to which when the public tries and buys the stock. Lastly, we have the blow off phase, when the smart money exits and the public then panic sells, as I talked about in the third point of the previous slide. There are 3 points that I'm going to cover with this slide. First one being the patient capital. So, patient capital is for those investors who want to invest for the long term without the view of making a quick buck out of the stock market. These patient capital owners do not want to uh, do have a purview of investing for the long term, and do not exit the stock probably for 3 to 5 years. Secondly, we have power of compounding. Power of compounding basically means that the money that you have profited from is being reinvested in the stock. So that money can also be the dividend or the profits that you gain from the stock. Thirdly, we have the market cycle. So the market cycle is basically the chart that is being shown in the right side. There are 3 phases that a stock goes through. That it can be a bull market, bear market, and a consolidation. Lastly, so it is advised to start slow and start small. Secondly, take advice from a professional or someone who knows about the stock market. Thirdly, keep it simple. Only invest in the funds or only invest in the instruments that you understand and that you can relate, or actually is pertinent to the long term goals that you have. It could be for retirement funds, or it could be your education funds, or anything else. Fourth point, SIPs. So mutual funds have two offers. One is the lump sum, or secondly is SIPs. So SIPs is one of the go-to instrument that I would recommend, which basically actually avoids you to invest all the money in probably over here where the stock is at its peak. It distributes your money overall of the market cycle and allows you to maximize your return. Lastly, ETFs. ETFs are the exchange traded funds. This is the most safe bet, I would say, if you want to venture into investing on your own. ETFs basically invest into the index funds, indexes like the Nifty, Bank Nifty, Nifty IT, etc. So Nifty has in the past Nifty has given 8 to 10% of return, which is considered to be good if a person is not managing or not actively trading into the stock market. Also, ETFs are uh, as ETFs are traded in the on the exchange, so these are far more liquid as compared to SIPs. So, friends, beware of the unsolicited stock tips that we receive. So, invest with a view of growing your funds and do not come into the trap of any trade market guru or any stock tip advisor. Happy investing. Thank you.